Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at the Fundrise Innovation Fund, or VCX.
If you find our talks useful, please consider subscribe, like, and comment underneath. And imagine for a second holding a portfolio that's just entirely engineered to capture the undisputed titans of the modern tech boom. We are talking about the absolute foundational layers of artificial intelligence and space exploration, right? So holdings like OpenAI, Anthropic, and SpaceX.
Weights, yeah.
Exactly. Now imagine logging into your brokerage account and seeing the value of that specific portfolio slashed by nearly 50% in just a matter of weeks.
That's a shock.
It's a massive shock. And that is the wild paradox we're untangling today with VCX. You have an asset holding the most valuable, rapidly scaling private companies in human history, yet the stock has just been in an absolute free fall. So the critical mission for you today, as an investor building a portfolio right now, is to figure out whether this violent drop is, a flashing warning sign to deploy your capital elsewhere, or if it represents the ultimate contrarian entry point for generation-defining wealth.
And solving that paradox really requires entirely separating the physical mechanics of the fund from the fundamental realities of the companies it owns. I mean, the surface-level price action driving that 50% crash, it actually doesn't correlate with the underlying health of the assets.
Wait, so the stock price and the actual assets are just completely decoupled?
Exactly. To grasp why the stock collapsed while the underlying companies thrived, we really have to look at the structural architecture of VCX. We are not dealing with a standard liquid equity here.
Right. It's a closed-end interval fund, right?
Yes, exactly. A specific financial vehicle that's engineered to capture illiquidity discounts and private market markups.
And that structure, that dictates the entire earnings trajectory for you as an investor. VCX doesn't generate revenue by selling software or consumer hardware.
No, not at all.
The fundamental value of the fund comes entirely from net asset value, or NAV, appreciation. It essentially pools retail capital to secure equity in these pre-IPO tech companies.
Pre-IPO companies that, frankly, the average investor is structurally blocked from accessing.
Right. Because of strict accredited investor laws and just astronomical minimum investment thresholds. It's what we call the access moat.
It really is an impenetrable velvet rope. You can't just open your brokerage app and buy a single share of SpaceX.
You literally can't. And VCX is basically the structural bypass of that IPO line.
Yeah.
But here's my question, right? Because these assets are entirely private and inherently illiquid, I have to question the day-to-day operational health of the fund itself.
How so?
Well, if VCX locks billions of dollars into companies that are, years away from a public listing, how does the fund survive a market panic? Why doesn't it freeze up completely when investors suddenly demand their capital back?
Right. Well, the survival mechanism is actually embedded in the interval classification of the fund itself. Regulatory frameworks mandate that interval funds maintain this highly calculated liquidity buffer.
Okay, so they keep cash on hand.
Exactly. They are legally required to facilitate quarterly repurchase offers. But those are strictly capped, typically at 5% of the total net asset value.
Got it.
So the fund essentially holds a strategic cash position specifically to process those quarterly exits. That ensures the vast majority of the capital stays firmly deployed in the high-growth, illiquid equity positions.
So it functions less like a standard checking account where you can withdraw capital on demand, and more like a time-release safe.
A time-release safe is a great way to put it, yeah.
You can extract your investment, but only when those predetermined quarterly windows unlock.
Yeah.
And that fundamentally prevents a devastating bank run from forcing the fund to liquidate assets at a loss.
Right. That intentional, calculated friction is exactly the mechanism that allows the fund to hold these monumental private assets through broader market turbulence.
And the value creation happening inside that time-release safe right now is just staggering.
Oh, it's unprecedented. Just look at the recent developments with OpenAI. They just closed a $122 billion funding round.
$122 billion, that's insane.
And we are not talking about standard venture capital here. We are looking at sovereign wealth funds and mega-cap tech conglomerates directly funding the AI infrastructure layer.
Right.
That specific round assigned OpenAI a post-money valuation of $852 billion.
Which completely invalidates the traditional startup risk profile. You're not betting on some fragile tech company burning through cash and running out of runway. And then Anthropic, another major holding, is backed by incredibly deep-pocketed partners. Microsoft, Google, they're aggressively fortifying Anthropic's balance sheet.
They are. The foundational assets inside VCX are thriving on just unprecedented levels of capital right now.
So, okay, here's the irony. If OpenAI is doing so well, why did VCX tank?
Well, that's the thing. OpenAI's massive valuation jump is the precise catalyst that triggered the VCX stock to collapse.
Wait, good news crashed the stock.
In a way, yes. The fundamental assets became so incredibly attractive to the broader market that retail demand basically shattered the pricing mechanism of the fund itself. It created a textbook structural bubble.
Right, because closed-end funds issue a fixed finite number of shares.
Exactly. Since VCX is one of the only liquid, accessible proxies for retail investors to touch OpenAI and SpaceX, the secondary market just got flooded with demand.
People wanted in.
Right, and buyers heavily outpaced the fixed supply of shares. So that caused the market price of the ticker to physically detach from the actual net asset value of the portfolio.
So investors stopped buying the mathematical value of the assets, and they just started buying the hype of the access.
Spot on. And that detachment reached extreme levels. I mean, prior to the crash, analysts were flagging VCX with a strong sell rating, specifically back on March 26th.
Because the premium was out of control.
Exactly. The ticker was trading at an astonishing 14.4 times premium to its underlying NAV.
14 times. To put that in the context of our velvet rope analogy, it's like retail investors were paying a massive exorbitant cover charge just to get into the club. Like a markup 14 times the actual mathematical value of the drinks inside.
That's a perfect analogy. And that totally unsustainable divergence is what attracted heavy institutional short sellers.
Right. Citron.
Yes. Citron published a highly publicized, brutal short report on VCX, but it is crucial for you to understand the mechanics of that trade. Citron was not shorting the fundamental viability of SpaceX rockets or OpenAI's language models.
They weren't betting against the tech.
Not at all. They were executing an arbitrage play against that specific retail premium. Their institutional bet was entirely predicated on the mathematical certainty that the immense gap between the inflated market price of the fund and the actual cash value of the assets would inevitably collapse.
And the short report basically acted as the pin that popped it, and the ticker violently crashed 49.21%.
Exactly.
But, I struggle with this prevailing capitulation theory that bulls are pushing right now.
How so?
Well, if I am an investor looking at a ticker that just bled half its value in a matter of weeks, a 7 times premium still feels like daylight robbery. Why isn't this simply a textbook value trap? Like, aren't we just catching a falling knife in a fundamentally broken pricing structure?
Well, the skepticism you're voicing is exactly the psychological barrier that's currently suppressing the stock. But when you analyze the technical mechanics of a structural flushout, it reveals a completely different reality.
Okay, walk me through that.
In closed-end premium collapses, the volume tells the story. The heavy trading volume driving that 50% crash was overwhelmingly weak hands.
The retail traders.
Yeah, speculative retail traders who chased the AI hype without really understanding the underlying premium risk. So when the Citron report induced widespread market panic, those speculative buyers all rushed for the exits simultaneously.
They realized the cover charge was an illusion and they just panicked.
Exactly. And by entirely fleshing out that speculative froth, the technical base of the fund undergoes a hard reset. The premium compresses violently, bringing the market price significantly closer to the true psychological floor.
Which is the NAV support level.
Right. We are witnessing a fascinating fundamental divergence here. You have the negative price action of the ticker crashing, but simultaneously, the fundamental momentum of the underlying holdings is accelerating.
Because the AI and space tech are becoming exponentially more valuable.
Yes. While the vehicle to access them gets dramatically cheaper. When institutional flow digests that reality, the dynamic shifts from retail distribution back to smart money accumulation.
Okay, so with the speculative retail layer flushed out, the premium risk is undeniably reduced. I get that. But simply having a lower premium doesn't autonomously build wealth.
No, it doesn't.
Something tangible has to force the net asset value upward, right? Like something to compel the broader market to re-rate the fund based on mathematical reality rather than fear.
Yes, and forcing that re-rate requires major, undeniable liquidity events. Fortunately, the catalyst calendar for VCX's specific holdings is exceptionally dense right now.
What's the biggest one to watch?
The most significant event on the horizon is the anticipated IPO roadshow for SpaceX. That's currently projected for as early as June 2026.
Wow, okay. Which would fundamentally alter the accounting math for the entire fund.
Yeah,
Because currently, SpaceX is marked on the balance sheet as a level 3 illiquid asset, right?
that's right.
So its value is basically determined by internal funding rounds and opaque private models. But a public listing introduces massive, transparent price discovery.
Exactly. Transitioning from a private market to a public market debut provides an objective, liquid valuation. See, institutional investors apply a heavy illiquidity discount to VCX because they can't easily verify the real-time value of its private holdings.
Right, they don't have a daily stock ticker for SpaceX to look at.
Exactly. So if SpaceX executes an IPO and the open market assigns it a massive premium, VCX's net asset value instantly, verifiably increases. The broader market is then mathematically forced to price VCX against that publicly traded benchmark.
Which effectively erases a massive portion of that illiquidity discount.
Yes.
It converts speculative paper wealth into undeniable public reality.
Hmm.
But, okay, let's pivot to the artificial intelligence segment of the portfolio, because that introduces a completely different type of catalyst, one that's, quite frankly, steeped in intense geopolitical maneuvering.
Oh, absolutely. The situation surrounding Anthropic's new Mythos model reads like a geopolitical cyber thriller.
It really does.
The capabilities of the Mythos model are unprecedented. It has been classified as such a formidable cyber capability that Fed Chair Jerome Powell and Treasury Secretary Scott Bessent recently held an urgent classified-level briefing.
With the major U.S. banks.
Yes, specifically to address the systemic threat this AI poses to domestic financial infrastructure.
That's wild.
Yeah.
We are talking about autonomous algorithmic capabilities that could potentially manipulate market data or bypass standard encryption protocols and do it faster than human oversight can even manage.
This is a massive deal.
A localized AI model prompting emergency briefings with the head of the Federal Reserve and the Treasury Secretary regarding the stability of the global banking system is staggering. And you combine that with the reality that Anthropic is currently blacklisted by the Pentagon and facing a massive legal battle over this exact technology.
Yeah.
I have to challenge this thesis from a purely capital preservation standpoint. If the Pentagon has blacklisted the company and the Fed chair views the core product as a systemic cyber threat to banking infrastructure, isn't that the ultimate bear case?
It sounds like it, doesn't it?
Like, how do you build long-term wealth holding an asset the federal government is actively treating as a hostile threat?
On the surface, regulatory suppression and Pentagon blacklists look like an insurmountable death knell. I get that. But if you analyze the history of mission-critical defense technology, it reveals a highly predictable monetization cycle.
Really?
Yeah. When a technology emerges that is deemed, quote-unquote, too powerful to ignore, the immediate governmental reaction is fear, containment, and regulatory blacklisting.
Okay.
However, that intense government panic actually serves as the ultimate undeniable validation of the technology's extreme efficacy.
Oh, I see. Because if the technology is powerful enough to threaten systemic banking infrastructure, the intelligence community inevitably realizes they can't simply ban it. They're forced to integrate it and control it to maintain geopolitical dominance.
Exactly. History provides clear precedents for this. Look at Project Glasswing and various In-Q-Tel initiatives where intelligence communities actively invested in and secured the emerging disruptive technologies they initially feared.
Right.
The regulatory panic surrounding the Mythos model basically proves the AI operates at an extraordinary weaponizable level. It is a scarce, overwhelmingly powerful resource.
So the government's immediate concern strongly hints at inevitable defense integration down the line.
Precisely. Eventually, the regulatory friction stabilizes, usually through exclusive, highly classified government contracts or specialized national security frameworks.
So the initial regulatory risk essentially monetizes into an enormous, highly defensible, government-backed revenue stream.
You nailed it. The fact that the Federal Reserve is terrified of the software actually becomes the strongest fundamental bullish signal for the underlying asset.
That is fascinating. So we're looking at a highly complex, multi-layered landscape here. We have the violent structural crash compressing the 14 times premium. We've got the inherent VIP access to generation-defining tech monopolies.
The impending public price discover of a SpaceX IPO.
Right, and the geopolitical monetization cycle of Anthropic. Bringing all these elements into a cohesive strategy for your wealth-building journey requires assigning a tangible conviction level to the fund.
It does. Synthesizing the structural risks and the fundamental catalysts, our official bullish score for VCX currently sits at a 7 out of 10.
Okay, a 7 out of 10.
Yes. That specific rating indicates high conviction regarding the sheer quality and long-term trajectory of the underlying assets. But it's balanced with moderate conviction on the immediate timing, mainly due to the intense volatility surrounding the ongoing premium compression.
That makes total sense. So the core thesis is essentially this. ECX provides a rare, highly liquid key to coveted private assets at the exact moment they're approaching monumental valuation inflection points.
Exactly.
And the 50% drop cleared out the speculative retail premium, offering a viable post-capitulation entry point. You are stepping in after the weak hands have been thoroughly flushed.
Right. But the timing of the upward re-rate depends heavily on the next major earnings event.
And for an interval fund holding level 3 assets, earnings are fundamentally about net asset value restatements. What's the specific filing we need to monitor?
The one you want to watch is the Q1 2026 10Q. This document is paramount.
Why that one specifically?
Because it serves as the official mechanism that translates private valuation jumps into the fund's legally binding balance sheet. Valuation committees within these funds utilize third-party auditors to mark-to-market their holdings based on recent mega rounds.
So the Q1 10Q is when VCX will officially mark up its stake in OpenAI to reflect that new $852 billion valuation.
Precisely. When the balance sheet is formally restated, the fundamental floor of the fund instantly rises. That documented paper increase acts as a forcing function, basically compelling institutional algorithms to re-rate the stock price based on the newly certified NAV.
But we need to be incredibly clear on the timeline for deploying capital here. Given the
And Anthropic's regulatory standing at the Pentagon, that needs time to evolve from a defensive blacklist into formal classified defense contracts.
And those deep foundational shifts in value creation, they just do not happen overnight. The investment thesis relies on purchasing the discounted access today and holding until the private market value transitions into undeniable, highly liquid public reality.
Well, the core lesson for your wealth-building journey today is mastering the divergence between market price and fundamental value. Sometimes the broader market's absolute panic over a structural issue, like an unsustainable retail premium violently popping, creates a backdoor entry into the world's most exclusive technological assets.
The ticker crashed, yeah, but the foundational companies inside that portfolio are capitalized and positioned stronger than at any point in history.
Exactly. The price of admission was drastically slashed, while the value of the assets secured behind the velvet rope continued to soar.
It's an incredible setup if you have the patience. It really is. Which leaves us with a critical broader question to ponder as you evaluate the future of your own portfolio. We are witnessing foundational monopolies like OpenAI and SpaceX delay traditional public listings longer than at any point in modern financial history. They are achieving near trillion-dollar valuations entirely within the opaque private sector. So as that velvet rope around the tech industry gets thicker and the barriers to entry grow heavier, will interval vehicles like VCX become the absolute only way the average investor can participate in the next generation of technological wealth creation?
It is definitely a structural shift worth watching.
Absolutely. Thanks for joining us today, and we'll see you on the next one.